Back in the action once again, as always. Feels great to be back here with you all here this evening. It's about that time of day again, though. Time to get back to work. Great day today. Big day coming tomorrow. It's Tuesday evening. It's June the 4th, 2019. My name is Joseph, by the way. And this, of course, is your nightly newsletter. Now, as you probably already know, I help traders find high-quality setups using a simple three-step trading strategy that we teach and trade together every morning in our trade room. But my job tonight is a little bit different. My job tonight is to identify the best levels, the best setups, and the best opportunities I see setting up for tomorrow. That's Wednesday's trading session. And tonight, we're going to cover some oil, some S&P, Nasdaq, gold, and we'll wrap up tonight on that mighty euro. I'm going to jump in here on the oil this evening first. I've got three big components setting up right now on oil. I've got a range, a channel, and then this thing just got clobbered by this afternoon's API report. Let's talk about those three components and how we're going to use those components, right? Let's jump into that oil chart here first here this evening. First of all, you can easily see here oil started off here as a range-bound market. What does a range-bound market tell me to do? It tells me buy low, sell high, and avoid the middle. Second component here is higher highs, higher lows. We have that channel, right? What does that channel tell me? Channel obviously has a bullish bias to it. It tells me to buy the low, right, of that channel. Third component, big, strong bear move down. Now this just came from the API report, which comes out every Tuesday afternoon at 4:30 p.m. Eastern Time. But honestly, that's not a big deal. What's most important right now is that strong move down. Anytime I see a strong move down, I expect to see another leg lower. So I know all three of these components are telling me exactly what to do. I get a range-bound market, buy the low of the range. I have a channel, buy the low of the channel. But I have this big bear move down, and that big bear move down tells me I've got to anticipate another round of sellers coming. So what I'm looking for right now is ultimately what to do if we get that second leg. I want to be a buyer up. Or maybe we see these sellers struggle in here, right? How could I buy into their failures? We're going to talk all about that strategy here in tonight's video, so make sure you stay tuned on that. We'll also talk about what if this market turns bearish and all the details in between. If you're an oil trader like I am, you definitely want to stick onto that. Stay tuned here. We'll dig into that oil chart in much more detail here this evening. Over on the S&P and the Nasdaq tonight, big short covering rally. Short covering rallies have a very frustrating way about them, don't they? You probably already learned that lesson today. Short covering rallies, you can see here, very shallow pullbacks. We obviously can see we are bullish. I have pretty much the only thing we do know on this chart right now is that wedge. The wedge tells me direction, it tells me location, it tells me entries, it tells me exits. That wedge is so important for our strategy going into Wednesday's trading session. But also, too, I have to tell you, anytime I see a short covering rally like this, I always expect to see one of two scenarios. I'm going to put together two different scenarios I'm expecting for tomorrow. And of course, we'll tie that into how to trade that wedge as well. Because obviously in this bull market, I want to buy a pullback. But sometimes when you get those short covering rallies, especially when you combine it with a wedge, it can be a little bit tricky. So we're going to go into more details on that tonight on the S&P. Over on the Nasdaq here tonight. Nasdaq, similar, right? Didn't get the wedge out of the Nasdaq. But as you can see, though, a very strong, right, 1, 2, and it looks like potentially, right, a three-legged move. Now, where are these buyers trying to go? I'm going to give you guys some targets that we're watching here on the Nasdaq for tomorrow. But again, with this short covering rally, right? This just razor sharp, right? Move higher, very small pullbacks on the way. It's easy to see it's a short covering rally for many reasons. We'll talk about these here tonight on the video. But again, short covering rallies can be tricky. They're a little bit frustrating, and boy, they can really drive you nuts if you're not prepared for it. Two easy scenarios to watch for tomorrow to capitalize on that short covering rally. We're going to dig into that Nasdaq here here, nice and deep here tonight on this video. Over on the gold, the yellow metal here tonight, as you can see here, there are really ultimately three main components on this chart right now. One is the overall bullishness, two is the trading range, and three is this really wide channel. Now, if you watch my newsletter, you probably know that wide channels can be one of the most tricky environments to trade because of one simple word, and that is momentum. So the bottom line is, I know that I have a bull market right now. I know I have a range-bound market. Anytime I have a range, I want to buy low and sell high. With the bullish momentum, I definitely want to be looking for buying opportunities down below that range. But again, because we have that wide channel, that momentum is a huge part of my plan for tomorrow. We're going to break that down here if we get the pullback. I'm also going to talk about what the plan is if this thing keeps going higher, because I got some targets waiting overhead as well. We'll also cover a full-blown reversal, a breakout. Got a lot to talk about tonight on the yellow metal, because I think this thing's just getting started here this week on the gold. Wrapping up tonight, of course, on the euro. The euro is much like gold, very much bullish and then into a trading range. Most important thing about this range right now is it appears to be getting narrower and narrower. That's a triangle. Now, triangles are a little bit different. Well, they're actually quite a bit different from your typical rectangle. So we'll talk about the best ways to trade a triangle. Triangles are really important clues because they tell me where to get in, they tell me where to get out, and they tell me when to expect a breakout. That's the big thing about, a triangle. I've also got a great spot here I'm waiting for, down around these lows, and I've got three basic patterns to look to buy that pullback here on the euro. We'll also talk about if this market makes a run for that big round number as well. So if you're a euro trader, definitely stay tuned for more on this video newsletter. I got the euro, gold, Nasdaq, S&P, and of course we can't forget about oil here tonight. I'm all locked and loaded, ready to go here. It is great to have you here with me as well. Before we jump into the charts and put the plan together for tomorrow, though, I want to remind you to make sure you never miss another great newsletter. Just before I publish this video on our YouTube channel, I send out an email to our best clients on our mailing list, and I want to make sure you are on that list so you know every night when this nightly newsletter goes live. To do that, all I need is your name, your email address, and then hit that subscribe now button. And don't forget, when you subscribe to join our list, you have to check your inbox, and sometimes our emails end up in your spam filter. So if you don't see it in the inbox, check your spam, your promotions folder if you're in Gmail, junk, any of those random folders. A lot of the Yahoos and Hotmails and AOLs and Gmails, love to do here. But make sure you check your inbox. Get that verification email, because that will not only confirm I have the right email address, but it will also give me a chance to send you a bunch of goodies so we can get the most out of working together every evening on this newsletter. So don't delay. Don't miss another great video newsletter. Join our mailing list. All I need is your name, your email address. Hit that subscribe now button, and I'll add you to our list, and you'll be the first to know when this nightly newsletter goes live. Now, I need your help. As always, I'm always asking for your help. Right down below this video, right in the comment section below, I need some feedback. What do you love about this video? What do you hate about the video? If you were in charge over here, what would you do more of, or what would you do less of? What's your favorite part of the newsletter, What would you cut out of this thing if you had your way? How do you use the newsletter? Do you watch it at the end of your day, like I do, or do you watch it before you trade the following morning, Which markets do you watch? Do you watch the whole video, or do you fast forward to your favorite market? Drop me a comment in the comment section below. It means the world to me that you would take a few minutes out of your busy schedule to tell me how I can make this even better. You know me. I come here every evening. I work hard here on this nightly newsletter to try to make this the best way to learn and earn on this video every every evening, and I rely on your feedback. So drop that feedback in the comment section below. And while you're down there, if you watch this video every evening and you find it useful to help your trade in the following day, do me a huge favor and give me a thumbs up on the video. That helps me expose this video to other traders who can benefit from this as well. And while you're at it, hit that subscribe button on the YouTube channel and set the notifications so you always get notified every time we publish something new. And please don't forget, if you have any questions, you can always pick up the phone and call me. I'm always here. I know I'm old school. I actually talk on the telephone, right? You're more than welcome. Call me anytime you have any questions. The internets, right, these days are filled with all this bad information about brokers, data, charts, markets. I'd rather tell you my experience, right, and let you make a decision, an informed decision from there. So if you have any questions as you get started with your new trading career, right, brokers, data, charts, or maybe you're just interested in a free pass to come out and join our trade room, or maybe you want to become a client and trade with us every morning at 8 o'clock Eastern time, call that toll-free phone number, use that live support tool in the upper right-hand corner. I look forward to answering the call, answering all your questions. That way you save time and you get all the right stuff right out the source. Now, in the meantime, thank you so much for your feedback. Thanks for the thumbs up, right? Appreciate that. Look forward to speaking with you. But for now, though, let's get to work. Tomorrow's Wednesday. It's June the 5th. What do we have here on the schedule here for tomorrow? Now, don't forget, we have that 2-day summit, right? We talked about this last night, Tuesday and Wednesday this week. Obviously, today is Tuesday, tomorrow being Wednesday. We have that 2-day Federal Reserve, what are they calling it, a research conference, right? Something like that. Boy, we talked about this last night, right? We told you how much that 10 o'clock was probably going to boom because of it. And sure enough, right, we saw a huge break higher, right, at 10 o'clock on most of our markets today. I do expect a little bit more of that tomorrow, so keep your eyes open at 10 a.m. Eastern time. Probably not going to be as explosive as we saw today. Typically on these 2-day events, the first day, the first time we hear from Jerome Powell is where the big fireworks happen. But hey, I'm always keeping my eyes open. I'm always keeping an open mind. And of course, we will be listening in tomorrow to see if we do see any new developments come out of that research summit. We also know right now we continue to keep our eyes and ears open about all the trade stuff going on, right? Today we heard about tariffs and negotiating trade deals with Mexico, right? Mexico came back and said, absolutely, we're more than willing, right? A very different response from Mexico than the U.S. is getting from China right now. And so all of that drama, right, is definitely underpinning these markets right now, and we are watching it closely in our trade room right now. Those aren't scheduled news reports for tomorrow, but obviously that is a vein that is running through these markets right now, especially after such a big rally in most of these markets today. Now, outside of these unscheduled events tomorrow, what else do we have tomorrow morning? Well, first of all, we have the ADP employment report. Now, this sounds like a pretty big news number, but honestly, it usually doesn't have that much of an impact on the financial markets. It may tomorrow, but not typically. Typically, that news report at 8:15, again, it sounds like a very big number, but it's probably not going to have that much of an impact. I would be more inclined to think that this ISM non-manufacturing number at 10 o'clock will probably have more of an impact for a Green Star news report, right? Anything ISM, right? ISM deals with inflation, so you're thinking currencies, dollar, gold, right? If the dollar keeps getting beat up, right, oil can jump, E-minis can jump. So that would be when I would expect the big acute reaction, right, to the news tomorrow morning. And then, of course, don't forget, tomorrow is a Wednesday. Wednesdays are kind of a half day for us oil traders. Now, I realize a lot of people like to gamble on the weekly news report, but, you know, I'm not much of a gambler, guys. I run my trading business like a business, which means I'm all about protecting capital first. And I'll tell you right now, if your goal is to protect capital and utilize your capital with good risk-reward ratios, the inventory report is the last place that I would recommend you do that. Very unpredictable, very volatile. I always tell people, this is a news event that can blow your account in less than a minute because your stops won't hold. You know, the knife cuts both ways, basically, right? You can make a lot of money in a short period of time. The problem with making money on the inventory report is that eventually you're going to give it all back. And usually when you give it all back, it's going to blow out your account as well. Take my word for it or don't, right? By all means, feel free to gamble around it tomorrow. But my personal opinion is there are 5 days every week, right? For about a half an hour, just one of those days, I stay away from oil. I look for those more reliable setups Monday, Tuesday, Thursday, and Friday, or anytime, really anytime on Wednesdays before 10 a.m. My cutoff on Wednesdays is typically around 10 a.m. Eastern time, and then I'll pick it back up right after about 10:45, right? Once that dust settles. You know, and again, I'm a relatively conservative trader because I've been doing this for a long time, and I know that I'm not trying to get lucky on one trade to make all my money on one trade. I'm trying to go nickels and dimes, adding up to dollar bills, and soon you get a big enough account, right? Those nickels and dimes are pretty big nickels and dimes, right? So not much of a gambler myself. You're more than welcome to gamble on that news tomorrow. I would recommend staying away from it from 10 o'clock till 10:45. So get to it early. If you're an oil trader, that's the key, right? Oil traders tomorrow, 10 o'clock is really that cutoff. It gets very slow ahead of that 10:30 news report, usually on Wednesday mornings. And then, of course, all hell breaks loose at 10:30. Once the hurricane calms down a little bit by 10:45, right, you'll have some opportunities afterwards. And then later on tomorrow, right, you get the beige book. The beige book isn't always going to be something to watch, but tomorrow it definitely is. The beige book, just in case you're not familiar, is the kind of the notebook, right? The notes from the last Fed meeting, right? So 2 weeks ago when we heard the FOMC report come out, right, and they changed all the guidance around, the beige book is going to be our glimpse behind the scenes of what actually led to the FOMC announcement, right, 2 weeks ago. The bottom line is sometimes this news event is a dud. In fact, most of the time, right, this is a dud. But right now, the Fed just threw a curveball at us. And everybody's kind of wondering, are they gonna cut rates, right? Because everyone's thinking, okay, the economy's struggling, trade wars heating up, right? Everyone's looking in, right? They're all kind of looking at this beige book tomorrow, thinking, okay, give us some in between. Let us read between the lines as far as what you're thinking into the second half of this year. So I do expect tomorrow at 2 o'clock, I do expect to see some reaction. The beige book, as you can imagine, though, isn't going to be, as I say, an acute reaction. It will be 215, 230. That's when you usually see, right, the best setups that come off that beige book, because it will take some time for the market to digest what it's being given access to. So we know we've got a couple big themes tomorrow. Again, we got that 2-day Fed summit. Right, we got the trade stuff going on right now with President Trump in the U.S. in Europe. Who knows what'll happen with that? And so there are some themes we're watching here under the surface. Big news tomorrow. I wouldn't worry about the ADP. I would definitely watch that 10 o'clock top of the hour, though, with that ISM manufacturing index. Or, again, if you're a crude trader, after 10 o'clock, skip crude, right? Stick around for the afternoon. And, again, you've got that beige book, right, at 2 o'clock Eastern time. Now, don't forget, we have a front row seat for all of this tomorrow morning because we trade together every morning in our trade room at 8 o'clock Eastern time. So, of course, we'll break this down and see how these markets react in real time tomorrow morning. In the meantime, though, let's get to work here right now because we got a lot to cover. Oil, S&P, Nasdaq, gold, euro. Starting off tonight on the oil market, like I mentioned in the introduction, there are three basic themes in this market right now. One is this range. Ranges always tell me to look for buying opportunities below, selling opportunities above, and of course, stay the heck away from anything right in that middle. So as the market goes lower here, right, the best pattern that I like to use is called a two-try failure pattern. And it's pretty simple. It's a pretty simple pattern to understand. Let me get rid of these notes here real quick. That way, right, I can draw on this sucker, right? But it's relatively easy to understand here. As we go lower, I expect to see sellers that are trying to sell off that moving average. I wait for those sellers to try to sell off the moving average pullback. I know where their stops are, and I look to buy right into those stops. This pattern, this failure pattern, comes in lots of different shapes and sizes. You can see an example back here, right? That's a 1 pullback, 2 failure and go. You can see an example back here, a little bit larger right here, right? 1, 2, and then go. So these patterns happen all the time, and that's exactly what I'm looking for tomorrow near the low of that trading range. So range-bound market tells me I want to buy below that range low. Now, one thing you want to avoid on this tomorrow is if you get that pattern like this. This is one of the sneaky ways the markets love to pick our pockets, right? They give us that pattern, right? They do. We get the pattern, but we don't get it below the range, right? So make sure you remember, don't make that mistake. Okay, I used to make that mistake all the time as a rookie. I would get so wrapped up in staring at the pattern that I wouldn't see the range, right? It's like that classic saying of, seeing the forest instead of the tree, right? So we have to scan where we are rather than just taking every pattern that we get. That's why I always tell you guys, don't focus on patterns, focus on the setup and the situation. Location, location, location. So the big thing though is that we have this big strong move down, right? Anytime we see a strong move in one direction, well, look back here. Look what happened. Anytime we see a strong move in one direction, what do we usually get? We usually get a second leg. So I've really got to respect this momentum. A very strong move down, we should see a second leg. Now, really, a lot of this has to do with how the market sets up, right? For example, if we get a strong move down, a pullback for a second leg, well, heck, now I got plenty of space here, right? I can buy into those stops. I can buy a pullback on the way back up, right? Failure pattern, pullback pattern, back up into that range. But let's just say it happens like this, right? We go 1, we get that second leg. That's a very different story now, isn't it? Right? That pattern isn't going to work if it's stuck right inside of that range. So what would I do in that situation, right? What would you do in that scenario if we end up seeing it like this, right? Where all you can really do is buy right in the middle. What I'll do is I'll look for a very specific entry pattern called a trap pattern. Trap patterns are my favorite pattern when you're running out of space. Let's say, for example, we roll over and go lower, but now the only way to get in, right, is to buy into stops, but it's in the range now. I don't want that pattern. So what I'll do is I'll anticipate the move higher, and I'll look for that 1, 2, what I call a nested failure pattern. The word nested, by the way, N-E-S-T-E-D, right? Kind of means inside, right? Think of those nested Russian dolls, right? Those Russian nested dolls, right? The doll inside the doll inside the doll, right? Think of that when you think about nested, right? So it's a failure pattern. It's a same basic pattern, but it's inside, right, of that setup. What you're looking for is you want that little trap right there, right? That trap that will set you up so you're not buying in the middle of that range, right? Stay away from the range, buy low and sell high. Now, what if we don't get it, right? What if it runs back higher here, right? What if it doesn't pull back here for us and it runs? There are ultimately 2 scenarios that you want to watch for here if it does make a run higher. First of all, if we run up and complete the pendulum swing, you'll notice the amount of the move below the range. I've got it marked up here, up around 53.89, right? That's the pendulum swing. Remember, anytime a market has a range, it means balance. And when the market moves outside the range and then back into the range, it usually swings, right, in a symmetrical distance, if you will, right? So the amount of the move below is the amount of the move above. So that area up here, right, 53.89, right? If we do break higher and we complete that pendulum swing, or in all reality, if we can just retest that high, that'll be good enough to me. At that point now, I know the bulls have a lot of strength on this. how do I sell high on this? I need a very specific type of entry pattern, and that is the 1, the 2, that nested failure, right? That nested. Now, what's happening here is I know the buyers have some strength. Momentum is on their side, but we're at the top of a range. Top of a range tells me to sell back down in. I can sell it, but I can't apply the same type of pattern, right? I can be aggressive buying off that low because of the overall bullishness, right, in this market. If I run higher, though, because of that overall bullishness we're seeing right now, I've got to let these buyers try and fail twice. Let them try once, let them try twice, and once I see those bulls trying once and trying twice, then I know where their stops are, and I can sell right into those stops for what is usually a pretty quick move back to the downside. Now, second scenario would be a breakout, right? What would a breakout look like? What if we get a strong move higher here? What would a breakout look like? A breakout needs to hold a pullback and run. Strong move up, pull back to the moving average, and of course, strong move off the moving average. We call these 1, 2, 3 reversals, or 1, 2, 3 breakouts. Once I see that breakout, again, 1, strong move up, 2, pull back to the moving average, 3, strong move off the moving average. You'll notice we almost had that back here, right? Strong move up, pull back. They almost got it, but it's obviously not, it's not a completion of that third leg, right? That third leg is we need here. Once we get that third move, that third leg, mark up that high, mark up that high, go down to that low, right? And bring up that low. That will give you now, right? That will give you now that sweet spot, right? The sweet spot here is going to be at that prior swing high, right? The low of that channel. That's a sweet spot. At the very least, I'm looking to buy the low, right, of that bull channel. Now, where would my target be as we go higher? If I take a quick look back left here, it's pretty easy to see here. We've got a big old range up here, and just like the E-minis right now, we may see a short covering rally up into that 55 area, right, as we go. Now, what if we break down to the downside, though? This is where things get a little bit tricky here, right? Look left. There is a big low, right? That big low, not from Friday, but from late Sunday evening. We got that low just a few pennies above that 52 big round number. The problem is I can't really apply. I can buy as the market breaks out higher, but as the market breaks down here, this is really going to be tight, right? We've got a major support level down at 52.11. If I get that strong now, 1, 2, 3, right? That big move off the moving average now, I really can't be a seller on this. It's very difficult for me to want to sell this market because there just isn't very much space down here. So I'm more inclined to look for the bears to try once, bears to try twice, and look for that trap. I call these crown reversals, right? Strong move down, bears try once, higher low, bears try twice, slightly lower low, right? Little trap low, that crown reversal for that buy going back up. Or, hey, if it keeps going, then so be it, right? If it wants to keep going at that point now and give me some confidence going lower, we can mark up that new channel and we can focus on selling off the high of that channel. But that will be after we see some proof that these sellers can actually handle this, holding it below that $52 a barrel. So once again, to recap here, I'm looking for, because of that strong move down, looking for a follow-up right leg. That will give me the ability now for a failure pattern, right, as we go, or maybe it'll be a trap pattern, right, if we have to be inside that range, or it could be a nested failure, right, off that high, or again, the 1, 2, 3 breakout. Those are easy scenarios looking here for tomorrow morning. Now, I have so many more setups, so many examples of this stuff that I would love to share with you. I've got limited time, though, on this video tonight. So here's what I want to do. I'm going to put a link in the upper right-hand corner here. If you're here for the first time, or you want to get a deeper dive into this entire trading strategy. I'll put a free course up there in the upper right-hand corner. I'll also put a big red button here below the video tonight on our blog. Grab that big red button right below the video tonight, or hit that link in the upper right-hand corner and grab your free trading course to learn all about my 4 favorite setups. You'll see hundreds of real examples from real markets of patterns we find every morning in our trade room. Everyone loves that free course. I'll also send you an invite to attend our trade room on a free pass on that free class as well. And don't forget, right, sometimes our emails will end up in your spam filter, so make sure you check your spam if you don't see that email, right, that I send you when you register. Let's keep going. Over on the S&P right now, short covering rally. That's the only explanation for a market that moves like this, and it's not too difficult to see what's happening, right? We had that big bloodbath towards the end of last month, and as you can see here right now, right, they pulled the plug on that, and it looks like they're running back up to that 2830, right, 2840 area. We talked briefly about this last night on the newsletter. So we have a pretty good idea of where they're trying to go. They're trying to get up to that 2830 area, like I mentioned earlier, right? They're trying to get up into that range right now. And the most important thing about this market is we've had zero pullback. And the reason why I said these types of markets can be frustrating is because they don't give you much pullbacks, right? There's very little pullbacks the entire session here today. And that is really what tells me this is a short covering rally. Now, let's talk about the mindset of the market in a short covering rally. First of all, the big reason why you don't get many shallow pullbacks in a short covering rally is because buyers aren't buying it. These are sellers getting out. This is very, very important about understanding the mindset so you know how to be ready for a short covering rally, right? When I have, for example, if I have a market that collapses last week, and then Monday we go sideways, then Tuesday we start seeing this kind of fluttering higher here, right? It's really, it's kind of slow. It's not a fast moving market, not that fast, right? But it kind of just keeps bleeding higher, right? It keeps melting higher. What's happening is these are not buyers buying this. What's actually happening is these are sellers who are trying to hold this position short, right? These are sellers who were holding positions, and now they're getting out. The only way to get out of a short is to be a buyer, right? When you close a short position, what happens? You have to initiate a buy order. You've got to buy your way out of that market. So one of the big reasons why these short covering rallies can be so frustrating is because if you're waiting for that nice deep pullback, it never came today. And so what I always tell my clients is once you recognize a short covering rally, you literally have to buy every red candle. It's kind of the only way to trade them, right? And anytime it pulls back below that moving average, you've got to jump in. You'll do a lot more trading. You'll take a couple losses along the way, but it's the only way to get in on that move, because if you're looking for a deep pullback, you're not going to get it. So the mindset of the market, it's the bears getting out, not the buyers buying, because where do buyers buy? Buyers buy low, right? They don't buy high. Now, here's the second step. Now that you know this move higher was not the buyers, what's going to happen when all the sellers are out of their positions? The market will almost always go sideways. So this is where understanding a short covering rally is so important, because a lot of times what happens is traders get so fed up, right, with this lack of a pullback that at the end of the morning, at the end of the day, the following day, they say, heck, just give me whatever you can get, and they buy it. Right? Basically, you're buying high. You're chasing after this market. Remember, when you recognize a short covering rally, you've got to get in, or else you've got to wait. It's simple as that, right? The train's leaving. You've got to get on. Any red candle, any pullback below that moving average, it's the only way, because the sellers are getting out, right? It's not going up and then pulling back to allow buyers to buy in. Okay, now again, knowing that once those sellers finish buying their way out, the market will almost always start going sideways. And this kind of ropes in a lot of the inexperienced traders, because they're expecting this thing to keep going higher forever, because it's been doing that so far. And so a lot of times what happens is, right, you'll get the okie doke. I always call it the okie doke, right? The okie doke is kind of a joke in our trade room where on a short covering rally, if you wait until the very end of the morning, you go, okay, I'm fed up. I'm done with this. I'm just buying, right? You're doing exactly the opposite of what you should be doing, right? You've got to get in early. And then if you don't get in early, you got to let this thing exhaust and start going sideways. Okay, trust me, this is not easy, and I've learned this by making all those mistakes, right? I've learned this by not getting in early and then out of frustration buying high later in the day only to see the market start going sideways on me. Now, what's going to happen now? Buyers, right? The buyers are still waiting. The buyers aren't buying this. Like I mentioned, these are sellers who are buying this. Where do the buyers want to buy? They want to buy low. And we oftentimes see a sharp pullback. That sharp pullback then stops out all the rookies who chased after it in frustration at the end of the morning. And what usually happens? Those rookies, and again, I was one of them for many years, right? They come in now and they say, oh, see, we're going back down again. They come in, they try to sell it. This is why I call it the okie doke. Right? It ropes you in going long at the very tail end of the move, and then it gives you a sharp pullback because the buyers aren't going to buy that high, right? Smart buyers are waiting to buy, and sure enough, what happens, right? The bears come back in and they take their revenge on the market, right? This becomes a revenge trade. You know exactly what I'm talking about right now. Most of us have made this critical mistake. Right? We say, oh, shoot, you got me at the highs. Oh, it's going back lower. Sell it. And guess what? That's where the buyers are waiting. That's where all the professional buyers are waiting. And guess what? Right? It runs right back up to retest the high because anytime you see a strong move in one direction, what's going to happen? Buyers are waiting down here. So this is the mental mind, you know what, right? That goes on with short covering rallies. You got to get in early. And again, how do you know it's a short covering rally? Two things. One, look left. If you just saw a big move down, and now two, you're not seeing pullbacks. That's usually the big clue. Buyers are buying into everything, right? They're buying the moving average. They're buying into the measured move. They're buying everything. Again, it's not the buyers. It's the sellers who are doing that, right? This is what's confusing about it. And right when you get fed up with it all, you say, oh, heck with this, I'm buying, right? It's 2:30, 3 o'clock, 4 o'clock in the afternoon, right? You're buying out of frustration just in time for those sellers to go, okay, we're out. Market goes sideways. Then the frustration sets in, price collapses, stops out those rookie buyers. They then try to take revenge in the market, and they're walking right into a trap. They're walking right into the okie doke, right? Because buyers now are waiting to buy down here, and they're going to be buying right into those stop losses of those sellers. Okay? Now, you'll notice I'm not talking about targets, right? It's very difficult to tell how far, right, this short covering rally will go, right? I have a good reason to believe this market will probably keep inching its way higher here up to that measured move, right? 1 and 2. Or again, like I mentioned on the oil, right? We do have these big ranges up here, right? That 28.30 to 28.40. So I would imagine that's where they're trying to go. They're trying to get up to that 28.30, 28.40 area. What I want to do right now, though, is I've got to wait for that secondary range, right? Get that range going sideways here. Once I have that range, then it sets the table now for that run lower, the okie doke, right, as I mentioned earlier, right, and then, of course, that run back up, right? You're buying right into the stop losses of those counter trend sellers. Now, there's a couple more things here you want to be aware of, right? First of all, this could keep going, right? And if it keeps going, I've got this wedge, right? This wedge lined up right there. That puts us right about 28.15. So if we move that up here, think of this whole area here as kind of like a little resistance zone up here, right? That 16 down to that 28.10 area, right? Give or take. So, be careful, right? Be careful. As the market tries to go higher, don't fall for, right, that trap of just buying high. What we're looking for is if it wants to keep going higher, let it keep going higher. Eventually, these bears will slow their pace down, will start going sideways. You'll see the market knee-jerk down. The moving average, right, will come over. The bears will try to sell it out of frustration. We know where they're, right, we know where their stops are, and we can buy right into those stop losses. Sometimes these wedges will also turn into spike and channels, right? So one more thing here, we may start seeing it start to channel out here, right? If it starts to channel out, starts going sideways on this, just keep waiting, right? Just keep waiting for that pullback. Get that pullback, get that failure pattern, right? And again, I'm just simply drawing up these failure patterns, but failure patterns are great because wait for those bears to run it lower, wait for that moving average to come over the top, wait for those sellers to try to sell that pullback, right? You know they will, and when they do, we'll be sitting right there, right, to buy right into those stop losses, right, into that pullback, and then back up from there we go. And again, I have literally hundreds of examples of this little sequence right inside that free course that I mentioned earlier. Now, what would it take to become a bear right now? Right? How on earth could this market turn bearish? It's going to be a very difficult job for this market to turn bearish. It'll have to give you that 1, 2, 3 reversal, right? That strong move down, that pullback, right? And that launch off that moving average. If they don't get that jump off the moving average on the S&P, right? If they get it, then we mark up that low, mark up that low, up to that high, right? And use that to find our channel. Then we know where our sweet spot is, and we're looking to sell off the high of that channel. And that pattern, by the way, right? That pattern, if you kind of zoom in on that on the little spot right there, that pattern is oftentimes going to be that same failure setup, right? That same failure into pullback pattern that I talked about going higher, right? And again, you can see lots of examples of those patterns inside that free trading course that I mentioned earlier. All right, guys? So bottom, look at this thing, right? Jumping up here again. So again, let it do it, right? Or the only other option is red candles, right? Red candles. The problem is you don't want to buy high. And I realize it's very difficult to watch a market do this like this, but again, you don't want to get caught buying high. So if you see a market that makes this type of personality, you can see, right? We got no pullbacks, no pullbacks, no pullbacks. Below the moving average, buy it. Below the moving average, buy it. At this point, though, you're very much too late, I think, right, on this short covering rally. You don't want to buy it late. That's the key, right? Once you look left, and you see there is potential for it, and then you see no pullbacks, that tells you right there it's a short covering rally. You got to get in, or you've got to wait for that range. You got two options, right? Either get in early or wait until that market slows down, wait to get that pullback. And sometimes, again, like I mentioned earlier, sometimes if you're not mentally prepared for it, you'll really get run over by trying to chase it and then taking revenge. Now, the Nasdaq is still very similar here, right, to the S&P. We know what's happening. We know it's a short covering rally, right? We know they're trying to go. They're trying to go back up into that range from the end of the month, right? So 72.20, 72.42, that's where they're trying to go. We blew right through the measured move here on the Nasdaq. And again, right, once you saw that they weren't getting much of a pullback here, you've got to get in, or as it goes higher, buying red candles. And I'm not saying it's easy by any means. These short covering rallies, thank goodness, they don't happen every day. They're not that common, right, in the big scheme of things. Right now, they become quite common because of the trade tariffs and all of the media, just really sensationalizing everything, causing these big swings. But the bottom line is, don't get too wrapped up in these just because, again, they're not going to happen that often. I would much rather have you say, you know what, Joe, I'm going to sit on the sidelines when this happens, and I'll wait for an easier market to trade. There's nothing wrong with that whatsoever, right? There are certain conditions that require you to be super aggressive, and this is definitely one of them. But again, those two things, right? If you look left and you see a big bear move down, and then you see today, okay, we're not getting deep pullbacks, it's a short covering rally. So then every time you see any shallow pullback, to be a buyer on it. But again, you don't want to wait until the end of the day to do it. This is obviously a very extreme case here right now, right? The problem is you don't know how far it will go. That's the problem, right? We don't see these markets. These markets are impulsive. They're emotional markets, right? They're not going to abide by a measured move. You don't know how far it will go. That's the tough part, right? That is always a tough part. So again, on this Nasdaq, I'm just hanging out right now, right? I'm waiting for this market to start going sideways on us, right? And once we start seeing some sideways movement here, then again, we know everybody who's long that bought high, once this thing pulls back, right, they're going to get pinched. They're going to think this thing, right, is starting to reverse, right? Sellers will come in, try to sell off that pullback, and I'll be waiting there, right, to buy right into that failure. Again, if they can miraculously hold off of that pullback and run lower, then I call that a reversal, a 1, 2, 3 reversal pattern. I'm going to mark up that low. I'm going to mark up that low, that high, right? And then, of course, we'll focus on selling off the high of that channel. Target for the bears is back down to retest that low. Target for the bulls, we're almost there right now at that 72.20, which I would assume is going to be the short-term target here for the bulls. We may end up all the way up to that 7,300 range that's waiting overhead. But at this point, again, we've made such a big move in such a short period of time. We are very likely here, right, going to end up going sideways as the sellers run out of bullets, right? Again, the sellers are exiting their position. As the sellers run out of their position, and the buyers are going, hey, I'm not buying up here, right? Again, the mindset of this market is the most important thing. Buyers are waiting down here, right? They're going to wait for it to pull back, and they'll buy with that failure pattern, that pullback pattern. And again, I talk all about this stuff inside that free course. It's also linked up below the video here tonight on the blog. So Nasdaq and the S&P aren't easy by any means, right? I'm definitely not saying they are easy markets to trade, but here's an example. Here's the yellow metal, right? The gold here. This is what happens, right, when a market makes big moves, right? Gold running 3, 4, 5 days in a row. And then what happens, right? Buyers stop buying it. Nobody dares to sell it because it's so darn bullish, right? Buyers stop buying, but nobody's selling yet. And the market, what does it do? It starts cruising sideways. This is exactly what you want to expect here on the E-minis, probably tomorrow morning at some point, right before 10 o'clock Eastern time. So as we see here on the gold, we have that bull market up. Right, we've got some double tops, some double bottoms here. I've got this as a range, as you can see. Anytime I have a range-bound market, I always know I want to buy low, I want to sell high, I want to avoid that middle, just like we talked about on the oil. Another very interesting factor about this chart is you can see the symmetry here. Strong move down, strong move down. We have to assume that a lot of the sellers are going to, at the very least, be using that measured move down here at 1323 as a target. So if I can think of a way to participate in a bull market at a level where I know the sellers are going to be getting out, how do you get out of a short position? You buy your way out. That appears to be a great spot here now to be a buyer, right? That would agree with the plan of buying the low of that range. And keep in mind, guys, you'll notice I take the size of that range. I use the size of that range to create my sell zones overhead, my buy zones below. I've also got a great looking reversal line here back at that 23.3 there for us as well. So we got a lot of great stuff down here inside this 1326 to 1323 area. And remember, all I want to do is I want to get this market down below that range and then buy it back up using a seller failure pattern. But that reminds me, right? Those sellers are gonna be pretty strong, right? Because look at this channel. Nice big wide channel. Now wide channels are important because of momentum. Momentum is, in my opinion, one of the most important things that a lot of traders don't pay enough attention to in day trading. Everybody learns about trend. Trend is bullish, trend is bearish, right? Trend is sideways. Not a lot of people get taught to respect momentum. Think about it. You can have a very bull market, right? The market can be a bullish trend, but then if you see a real strong move down, that is bearish momentum. I don't care if it's bullish long term. That move lower has to be respected. The bottom line is, if you try to buy that, right? If you try to buy that pullback now, chances are you'll get a little bit of profit out of it, right? Just enough to get you excited before those bears come in and they send it with another leg lower. Then, just as you get stopped out down here, right? You curse the buy. Just as you get stopped out down there, guess what happens? It runs right back up again, right? Because again, it's overall bullish. But you got to respect that short-term momentum. So the moral of the story is that if we do see this move go lower here, right, I'm going to look for really one of two patterns. One would be a second leg into a failure, or a strong move down into that nested failure, right? Let them try once, let them try twice, and back up from there. That will probably be the pattern that we'll see tomorrow morning or tomorrow afternoon. It's tough to tell when we'll get that. So let me clean this stuff off here. That way we can show you a little more detail about this, right? You guys know where that battle zone is and where that measured move is now, obviously. So again, I want to stay away from the middle, right? Don't trade the middle. The middle is the no trade zone. You don't want to trade that. You want to buy low. You want to sell high. Let's assume, for example here, real quick, let's assume now that we run lower here. There's a couple different things you want to think of. One would be a two-legged pullback, and that would be a 1, 2 legs down. Draw a trend line over the top, and then use that trend line. Again, respect the momentum of the market. Don't just try to buy the first move down, right? Because a lot of times it'll stop you out just in time for it to run right back up without you. Okay? That is a two-legged pullback. Now, maybe we also get a strong move down into that second try, right? Second try, we see that second leg going lower. Now what I'll do is I'll wait for them to try once, try twice, and buy from there. Usually that will give me an earlier entry, right? Buying here, then buying there, right? So look for those bears to try once, try twice. Again, strong move down. Let them have what they want, right? Let the bears take it for that next leg. Then look for the bears to go 1, 2, and then up from there, right? Because we know this is a key level of support down here. Or we see a strong move down, and like we saw back here, right? Strong move down once, twice, and then up, right? Strong move down once, twice, and then in from there. Remember, stay away from that range middle, buy that low, right? Buy that low. Now, where it gets tricky here is what if the market runs higher, right? If it runs higher, here's the problem. The problem here is we have a very bull market right now, right? It's obviously very bullish. So for me to want to sell up here, I can't be that aggressive, right? I've got to wait for that, what I call a crown reversal. So let's just say, for example, we run up, wait for the buyers to try once, but now pay attention here, twice with a trap. The reason why I like to look for a trap is because this is as counter trend as it gets. And really the only way you can do this safely over a long period of time. Yeah, I'm not gonna say you can't get lucky every once in a while catching one of these where it goes straight up and straight back down. Sure. But anyone who's been trading for more than a few weeks probably knows that catching a falling knife or stopping a freight train like that, it's rare. It is relatively rare. So don't let that fool you to think it's going to happen every single time. The bottom line is when we get a big strong move up, we almost always get at the very least a retest of that high before it comes back down in. So a strong move up, I want to see 1, 2, and I want to look for that trap. The reason why I look for that trap is because that trap is really the only safe place for a seller. It is. Because what's happening is, right, is the buyers are buying low, right? The buyers are buying low, okay? You'll have some rookies that will buy that breakout. because that's what rookies do, right? They buy breakouts. I was a rookie once. You probably were too, right? And when I was a rookie, what did I do? I bought breakouts. Why? Because, 3 out of 10 worked. And if you see a couple of them, you think that all of them win. Am I right? Right? That's the hard part about trading. We assume just because one specific setup works a couple days, we assume, boy, this isn't that difficult. What were they talking about, this difficulty? This is easy stuff, right? The problem is what works for a couple days in today's market condition, markets change and they morph. You probably have already learned that, right? I spent years testing new strategies when I was a rookie. It worked for a couple of days, and then all of a sudden, oh shoot, now I'm back in the red again, right? And you keep going through that kind of roller coaster where you try new strategies, they work a little bit, they fail, try new strategies, they work a little bit, and they fail. The reason is because those strategies, those setups don't hold up, right, with 100 trades. They might hold up with 3 or 4 trades, but they don't hold up over hundreds of trades. What we need a pattern we can rely on over hundreds of trades, right? Not just the trades take today or tomorrow or on Tuesday, right? It doesn't matter. So I want to find that pattern. This crown reversal, from my point of view, right, is really the pattern you can rely on when it comes to being counter trend. Are they all going to work? Of course not. Right? But no patterns bulletproof like that, right? When it comes to selling in a bull market, let those buyers try to buy once, let them try to buy twice. The thing is, you've got to be selling high, right? That's the thing. You got to sell as high as you can because that's where professional buyers aren't going to be. That's why, it's almost like in the movies, right? What's the word? The bad guy, right? It's chasing the good guy, and the good guy hides in the little corner, right, where the big scary bad guy can't get to him, right? It's kind of like that, right? You're literally putting yourself in a very specific situation, in a little corner of that move, where the big bad buyers, right, they can't get in there to get you, right? They're too big, right? They can't get in there. That's your only safe space. If I can sound a little bit more foolish with that analogy, right? But that's what I'm trying to do. I'm trying to find a way to sell in an environment where I know buyers are waiting here, buyers are waiting here. That's my only shot. Because if I try selling down, right? If I try selling low, well, what happens when you sell low? When you sell low, it requires you to use a big stop. And a big stop means you've got to take a big target just to get a one-to-one. Does that make sense? When you sell high, you immediately put yourself in a small risk, high reward opportunity. Over the long term, that's what's going to make you successful. If you try to sell low, right, you sell down here, now you need a huge move for that to make you a one-to-one, right? That's the problem with trying to sell in a bull market. If you try to sell low like that, you're going to have a very difficult time getting a good risk-reward ratio on it. There are lots of other reasons why this pattern works, but that's what you want to look for to sell off that high. Now, what does a breakout look like? 1, 2, 3, breakout. Mark up that high, mark up that high. Now remember, okay, this thing could easily go up. It could pull back and look very, very enticing here to be a buyer, but it's a range. Okay, you can't trust those range breakouts. Wait for the move to go through it. Mark up that high, mark up that low, right? 1, 2, 3. Mark it up, mark it up, mark it up. And then again, you're buying off of that, right? You're buying off of that low as we go. Buying off the low of that channel, right? As we break higher. Where's my target on this? Who knows, right? Look where we are. There's nothing up here. There's nothing up here. So where's my target? Your target is get rid of that final runner, trail your stop, and see how far the sucker will go here, right? I could give you some ridiculous extension here right now, but I'd be lying to you because when a market breaks through a range like that, it's emotion-based. Just leave that final target as a runner, trail that stop, right? And obviously tomorrow morning, we'll walk you through it together, right, in our trade room. Same thing goes to the downside, right? 1, 2, 3 to the downside. If they do hold that pullback to the downside, mark up that low, mark up that low, that high, right? And again, we'll gladly sell right off of that high if we can get that strong move to hold. Where's our target for the bears? boy, target for the bears here. There's plenty of space to go lower. I don't think they'll get to 1,300, but I would imagine that 1,317 area, right? That'll be an easy objective there for those bears tomorrow morning. Looking good. Gold is bullish into a range, looking to buy the low of that range. Be very, very careful trying to sell the high of that range. Use that crown reversal. And again, check out that free trading course I mentioned earlier for more details on all of these patterns. Wrapping up tonight on the euro. The euro is very similar here to gold. It is a strong move up, right, into a trading range environment. Again, just like we talked about on the E-minis, this is what happens when a market keeps going, right? Some poor fool got caught buying that high. Right? By the time they got stopped out, it came right back up to laugh in their face, right? That's the okie doke I was talking about earlier. We know we have a bull market. We know that bull market, I want to buy low, sell high, avoid that middle. What I really like about this euro is I've got this huge prior swing over here, and they ran right through it before. If I could choose my trade tomorrow, it'd be right off of that low, right off of that main low from before. We call those reversal lines. Now, we may not get that tomorrow. Hopefully we do, but that's my goal here. I'd like to be a buyer at that low. I've got one leg. I'm going to use a symmetry leg to find that again, around the 12,300 area. Once we get down to that area, get rid of this stuff off the chart here for you guys. Once we get down to that area now, right, now we look for that moving average to come over. Keep in mind on this one, you've got a falling resistance trend line coming down, so it's very, very important we try to get as low as we can. Wait for those sellers trying to sell off the moving average. Once we see those bears try to take it lower, now we know where their stops are. We can buy into those stops. We can look to buy the pullback, right? And again, a lot of this has to do with where that pullback was in relationship to that trend line coming down. Okay, remember, that's the key here with this euro, right? The euro has some resistance trend lines coming down, some support trend lines going. What else do we know? We also know it's a triangle. Now, triangles are notorious for big breakouts once they get close to the finishing point, the vertex, right, of that triangle. Most of the time, you will see once this market gets too congested near the vertex or the overlap of those two trend lines, once the market gets stuck inside the little point of that triangle, it almost always breaks out, right? Breaks higher or breaks lower. Now, the way this breakout works is it usually looks very, very enticing for a breakout, but it usually fails and comes right back into that range. Now, obviously, I can use a two-try failure pattern if we get that move going lower. If I get the move going higher, what I'm looking for is a 1, 2, 3 breakout to mark up that new channel, and then I can buy the low, right, of that channel. It makes sense, right? Does that make sense? So if this does end up, right, again, if we do end up kind of getting stuck inside this little triangle here, let the market shoot lower, let that moving average come over, let those bears try to sell off of it, and we'll just focus on buying right into those stop losses back up to where's a target? Right to the middle of that wedge, right? The middle of that triangle, right? Triangles are sideways, wedges are up or down, right? So triangle is a range. So we're trying to go back to that range. And what I like to do is I like to use the pendulum swing, the amount of the move below, amount move above, and that creates the final target for the runner. Make sense? Okay, where it becomes more tricky, obviously, if we do end up seeing that run, right, or that breakout, if it makes a run, make them hold the pullback, right? If they hold the pullback, good for them. It's a bear market now. Mark up that low, mark up that high, mark up that high, and we're selling off that high. Does that make sense? So at some point they're going to probably try a breakout, right? Once that triangle gets too tight. Okay, so once it gets too tight, break down, failure, buy it back up. The hard part's going to be if it breaks higher, right? If it breaks higher here, what you really want to do is you want to get in somewhere before you get to that big round number. The euro is a currency. Currencies love those big round numbers. We may see it jump up into that trading range up here around that round number, and then if it sits there for a while, we'll use that 1, that 2, that failure pattern below that range. Either that or we break out because we're bullish. I've got to be looking for, what was the pattern again? A crown reversal, right? So 1, 2, trap, right? Why trap? Right? Why trap? Because that's the only safe place for those sellers to get in. As a seller, you want to sell high. You don't want to sell low. But because it's bullish, buyers are buying here. Buyers are buying there. For all we know, buyers will buy more, right, as it pulls back. Only safe place to do it is to sell it up with that trap high. Where's your target? Your target, of course, is back into that range middle, right? Back to the vertex of that triangle. Or if it really runs through that measured move, through that round number, by all means, we can find that new channel, right, and buy that pullback. I would assume, though, if they do make a run higher here, they're going to probably end up getting stuck around that big round number, right, as it has a lot lately. We'll get that 1, that 2. Let those bears try once. Let them try to sell off the pullback, and we'll buy right into their failure. All right, guys, good stuff. Really good stuff here. Again, the triangle is the big component here right now. It's the big difference between the euro and the gold right now between these two charts. Great stuff here tonight, guys. Euro, gold, Nasdaq, S&P, and crude oil. We are all ready to go here for tomorrow. Now all I need is you. Tomorrow morning, we open up every morning, Monday through Friday at 8 o'clock Eastern Time. We take all this hard work and we apply it to real-time markets every single morning in our trade room. It's easy to get started. Just grab that link right below the video tonight. Right below me on the website here is a link to join as a brand new client as part of our advanced course. If you have any questions, don't be afraid to call that toll-free phone number. I'll be there to answer the call here this evening or tomorrow morning to help walk you through the process. If you're not ready yet to be a member, that's okay too. I've got the best free trial in the business. I might be a bit biased on that, of course, but grab that free trial because as part of that free trial, you get the free course, the free pass to our trade room, hundreds of hours of chart lessons for free, and of course, you get a much deeper dive into all the strategies that we use in our trade room every morning with all of our best clients. As always, it is such a pleasure to be here with you all. Don't forget, call, email, Skype, live support. I'm always here to help if you guys have any questions along the way. Give me that thumbs up on the video if you love the video. Subscribe to our YouTube channel. Drop me some comments in the comment section with questions. And I'll see you guys tomorrow morning, 8 o'clock Eastern Time at the opening bell. If not tomorrow, we'll come back and do it again tomorrow night. Same time, same place on our Wednesday edition of our nightly newsletter. As always, my name is Joseph. Be well out there. Be nice to each other, will ya? And be here next time. Adios, amigos. Bye-bye for now.